I'm Charles Waldron. I've been here with Lone Star for about 3 years now. I lead the acquisitions, so Dallas and Houston mainly. I'm the one, constantly in touch with the brokers and heading up analysis of the deals and all that stuff. And I put this together and with help of Brad, of course, our analyst. But this was a project that we've been working on now for over a year, every quarter. And this is our trade tracker, so it reflects kind of the most recent quarter of all the deals that we've looked at and how they stack up against each other, and you combine them together and you get a kind of a sense of where the market might be, at least our snapshot of the market.
Perfect. So just to add on for everyone, because a lot of people have questions when they first see the spreadsheet. So what you're seeing here is every single row represents an individual deal, and you can start to look at individual cells for data. So for example, the first market, you basically just see Houston or DFW. Those are the only two markets that we're involved in. So those are the two markets. The next column is marketed. So if it's OM, it's an off-market deal, or if it's market, it's a marketed deal. Now, obviously, we all know that there's gray areas regarding what is a marketed deal, what is an off-market deal. So we don't take it too seriously either way, but just generally speaking, if there's a full marketing process and a call for offer date, et cetera, it's marketed. So if something's if something's off market, we don't mean to say it's the most secret deal in the world. And then just for anonymity, the units column is actually I don't see that you got it randomized or rounded here, Charles. So are we sharing sensitive data?
Which one?
The units.
Those are rounded to the nearest 50. I mean, they're
okay. I see some that aren't, but yeah. So generally speaking, they're rounded to the nearest 50 unit, and then the vintage is the vintage. So so I mean, pretty transparent. We have a lot of information here, and every single one of these rows, like I said, represents a deal which we have underwritten. So we have a whole underwriting spreadsheet associated with each row here, and that's how we got the data. So every deal that we underwrite, we're able to actually adjust the expenses, adjust the revenue, and that's how we get to our cap rate that we'll discuss here. And so we're able to really compare apples to apples and say, okay, this deal's a 5 cap and this deal's a 4.75 cap, and those are meaningful because we're actually comparing them across uniform analyses. So yeah, hopefully that kind of sets the stage for anyone who's new to this call. And Charles, let's keep it rolling.
Well, yeah, sure. So you got kind of the basic physical attributes, guidance pricing on a per unit basis and per foot. And then for the market deals, just the overall table of cap rates. So this left side is what the cap rates and such would be if we were paying the price they're asking. And then on this right hand side, it's sort of at what we could buy it for, our bid, what the cap rate, and then the yield on cost, the difference between the cap rate and the yield on cost. This is a tax adjusted cap rate, on trailing. And then the development spread, which is the difference between the exit cap rate and your yield on cost. And then we're just showing our exit cap that we're underwriting, which helps you kind of contextualize, obviously, like the risk level and how these caps compare to where we're planning to end up, underwritten returns at the project level, and then at the unlevered. And then NOI. So this is just used to calculate the cap rate. And this is per unit, actually, NOI, and likewise per unit CapEx. So that just helps also get a sense of everything. And then this bid over guidance pricing. So this is essentially like the bid ask kind of ratio here for us. For 100%, we'll pay the price they want. And then we just have summary stats kind of showing where they are and against last year or last quarter.
Yeah, so let's start with kind of an easy topic, which are cap rates, and everyone's talking about cap rates expanding, interest rates are up, and going back in our data, we saw that cap rates bottomed in about Q2. And so, yeah, Charles, you want to zoom into that cap rate table just so it's really easy for everybody here to see. So Houston has better data for us because we weren't looking at a ton of product in DFW, and so the data is not as robust in DFW. So if you just look at Houston as a good example, you can see that we observed an average cap rate at the asking prices of 3.6 in the first quarter of last year. Then they bottomed at 3.3 in Q2, and then they started to expand, and then now they're expanding. And for the last quarter, we saw cap rates at 3.7, which I'm actually surprised to see that little of expansion from the bottom, right? It's only 40 basis points of expansion from 3.3 to 3.7. Personally, I thought this would be a bigger expansion. So Charles, do you have any context or points for that?
Yeah, I mean, I think obviously this is at the asking price. And I mean, a lot of deals in the last quarter just haven't even traded. So this is just a reflection of like kind of including a lot of deals of where they're asking. But like, first of all, not all the prices are as firm as they used to be. And a lot of them, if they are firm, well, they're just not trading at all. So that's not really a market clearing price at that point.
Yeah.
So the actual trade price cap rates will probably be better than this, I would imagine.
For sure. Also, if you look at, let's take Q1 of last year, for example, sellers were essentially asking for 3.4% cap rates. And then Lone Star, someone in the chat asked, what does LSC stand for? LSC is just Lone Star Capital. So whenever you see LSC here, we're referring to our underwriting. We're not saying that we're right necessarily here, or that, our way is better. That's just our process, and that's our analysis. So just as an example, in Q1 of last year, our cap rate that we would pay for the average deal, right, was 3.6%. So sellers were asking 3.4, and we would be willing to pay 3.6. So that's the relatively small bid to ask gap when we're approaching an opportunity. Now, if you look at the most recent quarter, Q4, the asking cap rate is 3.7, but our underwritten cap rate that we would pay is 4.5. That's a big gap. All right. So all of a sudden there's this big gap between buyers and sellers. So we're not unique in this. This is a market-wide phenomenon where there's this big gap. And that's, like Charles perfectly explained, the fact that sellers are asking for a price that is largely unreasonable. And that's why transaction volume across the country in multifamily is down 75%. Also, another really quick point, and then Charles, I'll let you keep going. I'm getting pretty frustrated with a lot of people out there claiming that they're seeing cap rates of X today, such as, hey, we're seeing cap rates of 5.25, 5.5, 6% cap rates. And I don't know what people are talking about, because we're still underwriting deals, and as you can see, the average cap rate that we saw was still sub 4. So I agree that value is trending higher, meaning intrinsic value. But, when investors push back on our deals and say, well, cap rates are 5.5% today, it's like, well, that's not what we're seeing. So this is the source of my frustration here. Charles, what are you're not as much involved in the investor side, but what are your thoughts there?
I don't know. I mean, I guess if they want to, maybe some of the ones they're buying might be like a 5.5. I could imagine a 5.5, but I mean, 6 sounds outlandish to me. And I mean, also, again, these are all asks, so they are going to be, if not at 5.5, like maybe above 4, I would guess, on trades. But it's definitely, yeah. So and it depends on the product type and all of that stuff, so.
For sure.
Well, I guess, I mean, there's the next kind of another topic that we can move on to is this matter of kind of like marketing versus non-marketed deals. And we kind of always been just tracking that. So This is actually the previous quarter. I think we need to label it, but so this quarter we're like 51-49 marketed, so actually quite a bit of marketing, although I would say that's like heavily the first half of the quarter maybe was more marketing, and the second half is probably more off market, right? And then the previous quarter there was quite a lot of off market. So I feel like what happened was that, you know, more towards like the summer, I guess there was a lot of off market stuff because the market really kind of froze, and then people wanted to sell stuff, you know, but like they also wanted to get the best price, and there's like this price discovery, right? So it used to be like in the first half of the year, not, you know, Q3, but like actually, you know, when rates were low and the market was hot, you know, everyone wanted to go through a marketing process. The price kept going up through the marketing process. You wanted to preempt the process, and it was impossible. And then it kind of, the market froze and there became a lot of off-market stuff. And then recently, like at kind of the first half of Q4, it was sort of everything's going through a marketing process. And if you want to have price discovery, it's going to happen at the end instead. Anyone will take their price they're asking for early on. So it's like flipping, right? When the price is going up, you know, everyone insists on going through the process. When the price is going down, you can buy it now at the unreasonable price all day long. And then, you know, finally, after a lot of those processes just failed essentially and didn't trade, then now you're kind of in this situation where it's a lot of stuff is just off market and kind of not really necessarily out there in a very serious way.
So I can't take credit for this. I saw it on LinkedIn and I thought this was spot on. Before everyone was looking for that off-market deal and they wanted to preempt a process, right? We would brag to our investors and say, actually, because of our relationship, because of our reputation, whatever, we were able to preempt the full marketing process because, like Charles said, the asking price was actually the floor price, and then it was going to get bid up from there. And if you could preempt the process, you could take it at that price and be done with it. And better if you could do that off market, right, to avoid the bidding process. And then now today, the attractive deals are on market, because you know if a seller is on market and willing to go through a full process, they're a real seller. They actually want to sell at the market clearing price, or at least that's you hope if they're going through the process. So it's flipped, which is really funny. And like Charles said, and I think this is also reflecting, or you could interpret in our numbers here, that the asking prices today are flimsy. Today, the ask price is here and they're expecting a trade below it. Whereas before in you know, the hottest market of all time, the asking price was here and it was basically, you better be here to have a conversation. So I do think while we're saying 3.7 was the average cap rate underwritten, you know, that's a flimsy price, where in reality, like Charles was saying, most of these trades are going to end up being in the low fours probably.
And a lot of them might just not trade, but that's like, you know, they're either going to be there or they're going to be, probably if they trade, well wider. And, you know, it's been interesting, like the most recent quarter where the bidding processes, you know, they have the call for offers and the price comes in lower. And it's like the seller's in denial and that the broker needs to show them that like they went and did the whole thing and here's what you have. So it's completely the upside down version of what, you know, we used to have. So it's quite interesting.
Okay, cool. Take us to the next topic.
Well, I guess the next topic was like not a lot of pain yet. So, I mean, yeah, which is why a lot of them aren't selling. So, you know, I guess there is some pain out there, but not enough to mostly force people to sell, which is a lot of the deals have just been shelved, you know, like they went out last quarter, or, you know, at whatever, and you can still buy it at whatever if you want off market, but they don't yet have to sell. And everyone's also just hoping that, I think, you know, it seems that rates will come in and their prices will go back up again and everything will be great. So, you know, that's kind of also seems to be pretty much what's built in here. But you could imagine that if rates were to stay elevated, that some of these guys on floating rate debt, and then you might see some more selling.
To go real quick, Darius in the chat brings up a very good point about strategy. And that's another thing that I think also is skewing our data, is the fact that we have trended in response to the market conditions to buying nicer property that is generally taking less risk. And that means you're buying newer property, which, newer, nicer property comes at a cap rate premium. So you're paying a lower cap rate for that. So that could be another thing where, cap rates are going up, but then we're buying lower cap rate strategy or style deals, and then that's bringing it down. So for us, just to speak high level, our strategy today is really focused on finding deals that we can acquire with fixed rate agency financing. And that makes us feel really good if we have, a 7-year loan in place, for example, that we can hold for long term if need be and ride out a downturn. Also, agency debt, if it's fixed rate, it eliminates that floating rate risk possibility. And also it's sized to in-place income. So it's not like we're banking on a business plan to kind of bail us out or get us into, above water. So it's a much more defensive strategy, which you can't go wrong with. And so that's what we're focusing on.
Yeah, and you can see, I guess, a tiny amount of that shift here, where we got 1 year newer in our average vintage. So I guess also, you can kind of see that the size of the deal essentially has gone down just a little tiny bit. I think the main hit to that already happened earlier in the year where, the debt proceeds came down. So we had to look at smaller deals, and just chasing very, very large ones with enormous loans became less of a just easy, straightforward option. What else here? I mean, I guess we could discuss this, or we can go on to the next.
Yeah. Do you want to cover the percentiles here?
Sure. So then this here, we're kind of breaking down the just the lay of the land as far as where we're coming in relative. It's like a slice of the market. How transactable are all the deals out there, right? Like, do you have to have a top 10% deal to make it work? Do you need like a 1% deal? Does not very much at all work? So I mean, I guess we're saying here that pretty much, I guess, the top 10% are making sense to us this quarter, which is actually, a little bit better than last quarter. I think last quarter there hadn't been as much adjustment. And also, I think we had been kind of pursuing, I think we've slightly kind of tightened the criteria this quarter a little bit so that we're just passing on some stuff that really doesn't make any sense, which probably is also helping this hit rate stat here. Because so this quarter we're at 98% at the 90th percentile. So the top 10% of deals were like at 98% of the ask price. Whereas, last quarter, top 10%, we were almost 10% off at 92% of the ask price. So, and we were showing lower returns than actually. So we were figuring that at that 92%, we were only getting 17% returns. Whereas this quarter, we're actually thinking we're doing a little better on that front. So, and likewise, the caps, have widened at this percentile level, I guess, right? Like the average, up there of 3.6 or whatever it was, 3.7, it sounds really tight, and it is. But, actually, I guess on this chart, you can see that, say, the median deal, now we're making a 4 cap at the ask, whereas it was a 3.8 last quarter. So there's been some movement, and the very most transactable deals are even better than that, right? We are seeing like top 10% maybe get a 5 cap, but I don't know, we still haven't got that 6, or 5.8 for the 99th percentile. So yeah, and then you can see yield on cost also, like how much risk we're taking. So that actually also is somewhat relevant, right? Which is that we're planning to do a little more, I think, in general to make these deals work.
Yeah, that's been a trend that's been happening for a while now. And I think, if anything, that trend is maybe going to reverse a little bit, just because if we're buying newer property that's more stabilized and taking less risk, then there's less to do. and there's less capex, less upside, but at least you're getting a more straightforward deal. I know that our capex budgets are down quite a bit quarter over quarter, which is a little looks large. Another thing too, you kind of breezed past this, but and we didn't talk about this in our prep call, but I forgot to ask, how many deals are we showing in the data set this quarter?
86.
86. Okay. Yeah, so it's a good amount more. And so we underwrite, I'd say, a little bit more than what we put in this, because some deals we preliminarily underwrite and we just throw away, and we don't really get to this level of granularity that it's worth putting into this spreadsheet. But with the addition of Brad, who is on our team working with Charles now, and he's on the call with us, that's added a lot more firepower to our acquisitions process, so we can underwrite more deals. And it's kind of an important thing to find the balance of not just underwriting every deal you see and just throwing more hours at trying to find a good deal, and being really smart and intentional with actually being selective up front to save time, and selecting the right strategy to focus on in the first place. So yeah, I'm happy to see that there's more deals that are here now in the tracker, but at the same time, more of the deals are getting closer to making sense. I mean, at the end of the day, it's all about how many deals you underwrite, and then the percentage of those deals that you can actually close. You don't want to just increase the denominator to make the numerator bigger. You want to find a way to make that conversion better as well.
Yeah, one more point on these, actually. I mean, you can see here that, so that's, the market is here. So the market, I guess, median was 4 cap this quarter and 3.8 Q3. And you can see actually our underwriting for our bids, we're actually kind of almost pretty consistent. So it's like we wanted a 4.7 cap, and then we still want a 4.7 cap. I think part of that is that we're also looking at newer deals this quarter. So like, even though the rates have widened a little bit, we're not as we're still at the same number, but it's sort of remarkable the level of consistency there, especially if the median deal is yeah. I mean, we've been here, and then the market's just come closer to meet us a little bit, and we've become more transactable.
Yeah, exactly. And also one of the when you suck, I don't know how to explain it, but returns out of the market, which is by way of, let's say, higher interest rates, that sucking out of returns has to go somewhere. It can go to lower prices, or it can go to buyers accepting lower returns. And so the market right now is digesting and trying to figure out, do we get lower pricing? Do we suck it up and absorb it and take on lower returns? And so I think one way for us to do it as an individual investor in the marketplace is to, like Charles said, go for a nicer product where we feel more comfortable taking on a lower return, right? Obviously, one of Charles's favorite catchphrases is return-free risk, right? There's no point in taking return or taking on risk if you're not going to get increased return for it. So that would lead us in the direction of saying, well, let's just accept the lower return deal that we are more in love with, more comfortable with. And so you can see it's not a big move here, but you can see, like Charles was pointing out, the 50th percentile, we want a 4.7 cap from quarter over quarter. That's stable, but the projected IRR associated with that 4.7 cap went down only 1%. So it's not this huge data point, but it just shows you that we're sucking up a little bit of that reduced return, going from 21 to 20 as in our bidding strategy.
I mean, part of that's also that, like the IRR's got to stay kind of constant, because like that's our return box. So, I mean, it's like, are we able to achieve the IRR cap rate? Yes or no, but we kind of have to be there.
Yeah, we don't have so much flexibility where we can underwrite to a, I don't know, 12 or 11, like an institutional. We don't have institutional that would back us on those terms. So we do, like Charles said, have to stay in our return box for the most part, but there's wiggle room. Just to take a couple questions really quick. Eric asks about submitting offers on most of these deals. Charles, you want to just give an overview of our offer process?
Yeah, I mean, I think mostly we're kind of verbal feedback unless we're pretty close. Although these days, I mean, you get let's just submit that more than you used to. I guess you could submit first to try and shake it loose, especially if they don't really have very specific pricing. But but yeah, I mean, it's kind of the top, I don't know, quarter, 10%, somewhere in that range. We'd probably bid on most of them. Going to be verbals or a pass.
Yeah, it never hurts to just have an offer in. The brokers like having offers because it's something they can show the seller, and it's actually, it shows the seller that the broker's doing their job. They're soliciting bids, receiving bids, and it's also a way to provide education, right? If the seller is stubborn and says, I need 50 million for my deal, and the broker can show up to the seller and say, well, here's 10 offers at 40, that's going to start to reorient the seller's brain and understand, well, my deal's probably not worth 50. But if the broker just goes back and says, well, I've had 10 phone calls and they're all telling me 40, it's not as strong. So that is that's one thing. It's always good to have offers in, and it's something for them to circle back to. It's a lot of luck on stale deals. It's a lot of, I mean, obviously you need to have a relationship and reputation, but a good deal often comes by way of the seller finally making that decision and saying, okay, you know what, fine, my deal is worth less. And that's when they call the broker, and then the broker has one phone call to make to all the buyers that were willing to transact at that lower price, and you hope that you get that call that finally, when the seller changes their mind, you're top of mind. Jeff is
Oh
asking.
yes.
Go ahead.
Yes. So we do put out LOIs, not necessarily just to get a bid, but also to assist with the education process. I mean, it is good for that as well.
Yeah. So Jeff is asking, or he's stating, so you close on 1 out of every 10 properties reviewed based on your KPIs. I think our hit rate is quite a bit lower than that. What is our hit rate for Q4 at least?
Well, I mean, Q4 is honestly pretty light, right? Because I mean, we haven't closed any deals that we put under contract in Q4.
No, but I mean, but let's just look at deals that we put under contract in Q4 out of this bunch. I don't think
we have 4, I guess, right? 3. I don't know.
No,
Yeah.
One technically.
Right. So
yeah, I would say the hit rate, generally speaking, as cliche as it is, I'd say it's generally around the 1 out of 100.
Yeah, it's very low. I mean, because I mean, how many even this year, right? I mean, if you're figuring we probably did like 300, 400, this year.
At least, yeah. Yeah, no, so it's about 1 to 2%. Yeah, and Darius brings up another good point about IRRs being down. One of the other ways to get comfortable with lower returns is through lower leverage, right? You can't expect to chase after the same returns if you're using 60% leverage versus 80% leverage. They could be the exact same deal, but the 60% leverage deal is obviously going to be a lower return. And if you're a savvy investor, you might be willing to look at that 60% leverage deal and say, well, yeah, the return's a little bit lower, but the risk profile is that much better, and pick that over the higher leverage deal. Unfortunately, in today's market, there's really no choice, right? It's very hard to access high leverage unless it's painfully expensive. So it's making the decision a lot easier. But back, a year ago, it was a harder decision because marginal leverage was essentially free. You could actually, in certain cases, borrow bridge leverage for cheaper than lower leverage permanent debt. So yeah, no,
And you kind of had to win deals a lot of the time. I mean, and I think a lot of the kinds of people who are like, oh, I'm going to go low leverage and they just weren't buying anything. I mean, probably at that point of the market. And actually also, so I think I finally figured out what Jeff was saying, which was he was like, oh, okay, so about 10% of the deals, according to this, you know, come to 100% bid ask. But it's okay, so yeah, but the numbers alone, you know, just because you are able in your model to get to 100% of the price doesn't mean you're going to close it, right? There's a lot of fall off, like, oh, you got beat to the punch, you looked at it and it turned out that it was deficient in some other way. I don't know, if we were busy working another deal. I mean, there are all kinds of reasons why, you know, the numbers would work, but we wouldn't buy it. So
There's always a handful of deals that we're there on price, but we just choose not to move forward for, like Charles said, for various reasons. Charles and I will be sitting in his office, kind of battling it out over, back and forth on the deal, right? The numbers are there, we're looking at it, and the price makes sense, but then just can't get comfortable for one reason or another. And yeah, so it's not just an automatic buy if if we can meet the asking price. Let's take a couple more quick questions, and then Charles, you can prepare another talk track if you have one, or we can just open it up to broad questions. So chat about seller financing. We haven't done any seller financing. We have I don't know, have some conversations, but in the end, we've gotten some price reductions on the last handful of acquisitions just to accommodate the changes in the market over time. Retrading deals is never a good thing, and it's looked down upon by the market. So we definitely look at our reputation first in those scenarios, and we're not just going to retrade a deal for the sake of it. It's a collaborative effort with the seller in a way, as bad as it sounds, right? Asking for the seller for a price reduction, but it's a collaborative effort because the seller wants to close the deal as much as you want to close the deal. And if it makes sense for them to reduce the price to accommodate you, then it's a win-win, unfortunately. So yeah, that's been the reality for us, more so than seller carry.
I mean, if the debt, which is the biggest investor, decides that they've changed their mind, I mean, at the end of the day, something might have to change.
Eric's asking about property price not yet determined, and they have a button for submitting a letter of intent. Are those listings worth the time commitment? So in our space, there is no official asking price. Charles will be on the phone with brokers and say, what's the pricing guidance? What's the whisper price? And there's always a price. There's always guidance pricing. And
almost always, yeah.
Almost always. And that's what we work off of. We don't need a guidance price, right? We're not, I would say, we're only human, so we are influenced by the asking price, but we're going to still do our underwriting, look at the deal, and then come back and submit an offer at what makes sense for us. So, if you're a good investor with a confident acquisitions process, you don't need guidance pricing.
Well, it's a time management tool though, right? It's like, are we going to have a deal here or not, right? If the guidance is here and you're just way off, then we're not going to spend lots of time digging in on every assumption to try and figure out how to make it work. If we're really close, then we might. So that is sort of where it definitely has some meaning.
Yeah, that's a really good point. Yeah, if the seller has an unreasonable price expectation, then that's a great deal to move on from and save time.
But yeah, it is kind of not, I don't know, when you see like no official price, I feel like that just means call me.
Yeah, exactly. It does them no good to put dates and prices on any marketing material when it comes to selling property, because if you date an offering memorandum, now there's a record of them trying to sell it at that time. So if they shelve it, go back to market, and it's a year later and you have dates, that looks bad. And similarly, if you have a price of 20 million and then now you're whispering or you're going back to the market asking for 19, well, buyers are going to question that. Well, why? You didn't get your price that you wanted. There must be something wrong here. That's typically why they avoid.
Or you might be unreasonable. It might not be worth our time to pay attention to you. We've already seen this. No one was able to buy it last time.
Yeah. You really do. People kind of sometimes overlook these things or call them cliches, but it really is true that you devalue your deal if you, for example, have multiple brokers shopping it at the same time, or if you have an unreasonable price expectation, don't sell, and then you come back again to the market and try to restart. And that's why sellers really do put a really big premium on certainty of execution, because if you let a buyer put your deal under contract and they don't perform, the market may have changed in that time, and it may be hard for you to get the same price again. And even if the market's the same, it's still going to be hard to get that same price, because now your deal has fallen out of contract, and there's a potential story about it, and people are gonna, like Charles said, have seen it again and have their question marks. Alex is asking about examples of things we found during due diligence that made us cancel the deal after being under contract. So let's just, publicly state that, we don't make it a habit, nor take lightly, nor do often put deals under contract and then not move forward. I mean, every deal, I think pretty much every deal we go hard on day one. So we don't walk away from deals. We do our upfront DD, and once the deal's under contract, we perform. So if a seller's listening to this, we're the best buyers in the world, and you should award us your deal. So
yeah, loaded question there.
Yeah. So as far as due diligence that we've seen that made us not like the deal, we have found deferred maintenance that is curable, or potentially incurable due to it being so expensive to fix, and it's just an infrastructure risk that we don't want to take. We've upon further review backed away because we did not feel like we no longer had the same confidence in our projections. We didn't think we could get the rents that we originally thought after further review. I don't know, Charles, do you have specific examples? I know Craig just texted me, he said stab locks. That's a great one. I mean,
you would have figured that out hopefully before you got on the contract. I mean, that would really be pretty bad.
If you are under contract, and we did have a deal where the seller promised us that there were no stab locks, and then there were. That's not good. But stab locks are fixable. Boilers and chillers are not fun to deal with, and it's pretty much a showstopper for us. We are not really in the business of buying deals with boilers and chillers anymore. Just trying to buy newer product, nicer product, no flat roofs. Not necessarily because flat roofs are bad. They're really not. But it's just a lower quality of asset that just has less appeal. Charles, maybe one more example of a DD item.
DD, I mean, I don't know. I think because, I mean, by and large, right, like we don't back out after finding these things, right? Because hopefully we figured them out ahead of time. And like, if you're just getting the right price and it makes sense, you wouldn't be terminating because of one of these things you found. So I guess I'm kind of struggling a little bit on that front. I mean, obviously, if they lied to you, which has happened, about something enough, then that, I mean, it basically is kind of the main, they're, oh, well, they're all like this. And then you turn up and you look at them and they're not. Okay, well, that's kind of a problem.
Yeah, that is a problem. Do you have any more topics here?
Yeah, talk tracks. We got one more talking point, which we sort of hinted at, but it was about the vintage thing, right? So, we kind of saying we've been looking at the newer product this most recent quarter, and it's also because of the market, right? It's not just, I mean, we do like newer product. It's definitely more attractive, but what's for sale right now, right? I mean, the older stuff, it's two things, right? It's from both sides, right? So I guess the older stuff, which we used to buy more of, right? I mean, that market is not really in great health right now, right? I mean, because a lot of that stuff was bought recently at a high basis by these people with floating rate debt, and it's in trouble maybe, but now is not an attractive time to sell if you're in that situation. So no one wants to, and everyone's just going to hang on for dear life. And of course, at the same time, with the rates being up and capital being harder and everything, those deals are also the ones that were stretched the tightest, and compressed the most ahead of time. And now they're hit the hardest relatively, right? I mean, so that was kind of the highest volatility, and it's there's a big bid ask or a gap, or that market's quite frozen. I mean, and a lot of the sellers just don't want to, now is not a good time for them. And the flip side, there's newer products, right? Because Well, I mean, it's less impacted by the moves because it's quality product. And then also the sellers, are kind of tend to be more sophisticated or willing to sell. Like if you're just got a huge portfolio of gazillions of dollars and, you're looking at the macro situation, maybe you just want to sell and you'll be disciplined about it. And you're even going to lose money maybe in some cases for specific reasons. We've seen a couple of deals where like the seller is apparently losing quite a bit of money, but they're doing it for reasons. And then there's also developers, if they've developed it, then those new builds are still available. But so like the kind of BC rougher value add space is really tough right now and nobody wants to sell. And it's not a great time, in terms of pricing, obviously for those, they've really been hit hard. And then, the newer stuff is kind of more what's available, both because of more realistic sellers and also because of it making more sense.
Yeah, it's institutional owners are more willing to be realistic and cut bait than if you're we're a sponsor, we're a syndicator. Syndicators are more likely to buckle down and want to ride it out and get to the other side of it and delay what may be a bad outcome or try to protect from bad outcome rather than just writing it off and moving on. I'm not sure which strategy is right or wrong, but that's by and large the divergency as far as who's selling and who's not right now. So yeah, I think that's a really good point that we hadn't mentioned yet. Deepak is asking about assumable loans at fixed rate terms, and have any of our prior deals been loan assumptions? So yes, we have done loan assumptions in the past, and yes, I've written somewhat extensively, if I ever do write extensively, about loan assumptions in today's market. Definitely an attractive thing to do, because if you can assume a loan at an attractive rate today, it's a great way to make a deal pencil and meet the seller's unrealistic expectation if you had to finance on today's market terms. So yeah, absolutely. I mean, that's a no-brainer. The only problem about it is everyone else that you're bidding against for the deal is underwriting the same exact loan terms, right? So it's not alpha. You're not creating a competitive advantage for yourself. It's just maybe a better deal in the market.
And they're more able to sell at a level that makes sense for you because they financed it nicely, right? Like if they had a tougher loan, they would need a higher price to come out okay.
Andrew asked about converting LIHTC deals to market. We've never done that, but I don't think it's that challenging. The challenge is waiting and being in the extended use period, or the initial period needs to expire so that way you can take it to market. I don't think it's that challenging. The oldest property that we wouldn't go beyond, I don't know, it depends, because there's some 70s vintage deals that kind of camouflage as 80s vintage deals. So it's not necessarily a vintage thing, it's more so what does the product look like? Is it, if it has aluminum wiring, even if it's remediated, that's just kind of a negative, but it's still probably doable. If it has flat roofs, negative, but still doable. Boilers and chillers, we just most likely wouldn't do it. That probably kills the deal. So those are kind of the things we focus on, is the infrastructure. What are the roofs like, plumbing, electrical, HVAC. Okay, cool. Well, that is, looks like the chat is slowing down, but we still have plenty of people on the call. Thank you so much, everyone, for being here and sticking around. Still have some time for more questions, so feel free to ask questions, whether in the chat or you can open it up and unmute yourself. We're here to talk. And usual questions that come in around this time is this recorded? How do I hear about the next one? Is there a next one? So yes, this is being recorded. We'll be posting the recording sometime in the next day. And then we send out, if you registered for this, we have your email, so we'll send you the recording email. And we host these quarterly. So this is a quarterly call. Next month, we have the asset management call. I forget, we call it the portfolio analysis call. So that's with Josh, our asset manager. So Josh and I don't really talk much. Josh runs the show. He has a good PowerPoint that he puts together, and he goes through our data visualizations on the portfolio and shares insights kind of on a portfolio level as to what we're seeing. So that is that's next month's webinar. Okay, cool. If there are no more questions, we can log off. I see Jeff coming in with a last minute question. What are the aversion for boilers and chillers? Yeah, cost to replace. It's expensive to replace. They don't run as well, so they can be problematic. I don't know.
If they're not in optimal working condition, they can lead to moisture issues, which can then degrade the actual physical property, and also like it limits the where you can take it as well.
Yeah, it can only be so nice of a deal.
Quick question, guys.
Yeah,
what's your expectation for values going forward with what's happening lately with the whole inflation stuff? We do some analysis on the back end on the yields and the charts and all that sort of stuff, and we see potentially much worse times coming for the US. What do you do? Any sort of background checks like that? Do you do anything to see where you're forecasting your properties in the future? For example, your exit prices, your exit caps. How are you coming up with that figure?
Yeah, sure. So I would say we've seen, so we're not economists, right? And so we're not paid to be economists. So we are real estate investors. So the way we approach exit caps is somewhat straightforward, which is just where we see the market at, we'll go 50 bips wider. That's just generally speaking the protocol. And to put our economist hats on, I mean, Charles and I talk a lot about this stuff, but again, we try to underwrite impartially and just stay neutral. And before I answer this question any further, I'm going to take a quick pause on behalf of Craig, who's texting me a million times to make sure I don't forget to give a call to action, because I'm never giving calls to action. So if you have any questions about working with us, if you want to invest with us, if you want to find out about what deals we have going on, please reach out to us. Craig's our new director of business development. He's much friendlier than me and better to talk to. So feel free to reach out to him. And what else can I say here? Yeah, we have some deals going on live. And also Dasha is always pushing me to give calls to action to our summit happening in October. I know October's a million years away, but we'll be mentioning more about that once the website goes live in about a month or so. So yeah, that's all the selling on my end for now. But back to the question. So with my economist hat on, Charles and I don't necessarily always agree, but I would say that we've seen, taking this data aside, I would say we've seen about a 50 basis point expansion in cap rates, and I think we're due for another 50. And that's just what I see. I think that's my simplest answer.
Appreciate it.
Yeah.
Charles, you want to say?
Well, I mean, I think people can see the cap rate, right? If people disagree with us about the macro scenario, then they shouldn't be investing in real estate at this point in time, right?
And also, we don't know how long cap rates will hang out at the peak, right? If
many people, right? Like if it's like every day you open Bloomberg, Jeff Gundlach or whatever says that like the Fed's gonna chicken out. Other guy says that I don't know. These guys are much smarter than me. People disagree, but I mean, I think obviously it seems to be thought that it could go either way, essentially.
Yeah. So what do you do? I mean, obviously taking a longer term approach is the best way to go, because it allows you to ride out any potential downturn, and the likelihood of reversion cap rates going to an attractive place again gets greater with every year that you project. And I mean, we're not projecting 10-year holds here, but if you were to look at a 10-year horizon, you would, at least in my opinion, feel reasonably good that you are, you're not going to be forced to sell in 10 years time at a cap rate that's really wide and kills your deal. Probably somewhere in your 10-year hold period window, you're going to find an attractive market that you could exit or refinance into. Okay, very cool. Well, thank you for bringing that up. It's always good to throw in a little macro discussion into these calls. We do get into the weeds on these calls sometimes a bit more. So this was a pretty.
Just to add to that, I'd love to chat to you both or whoever, right? Just to talk about more about this macro stuff, because we do a lot of our discussion. Well, all our acquisitions are based and our sales are based on that sort of macro data, and we do a lot of sort of quantitative analysis on the charts. So I'm not saying I have the answers. I'm just saying that there may be things that if we work together and collaborate, maybe there's things that we can all see and think, how is that going to affect our future exits? And I'm, we're in the real estate game as well. So I've spoke to you, Rob, quite a few times, I think. So it'll be great for us to sort of get back together and talk about what our future exits look like.
Sounds good.
All right. Cheers.
Very cool. All right. Well, again, thanks everyone for being on the call. Really look forward to next time already, and I will see you guys soon.